A major accounting mismatch, an estimated 1,500 crore rupees derivative loss, a major hit on net worth, a CEO in regulatory crosshairs, multiple investigations, and added to that, allegations of insider trading and disclosure rule violations. Has IndusInd Bank got itself into one of the biggest financial fiascos in recent years? Let's find out. It's Friday, the 28th of March. I'm your host Anirban Chowdhury, and this is the Morning Brief. Now, IndusInd, founded by S.P. Hinduja, was a child of liberalized India, named after the ancient Indus Valley civilization, but envisaged as a new age private sector bank. Its life between 1994 and 2008 was largely unremarkable. IndusInd operated as a small-sized commercial bank focused largely on retail and SMEs, growing steadily but lagging behind the HDFCs and the ICICIs of the world. Then came a pivot in 2008 when Ramesh Sobti, a veteran banker from ABN AMRO, joined as IndusInd's CEO. Sobti revamped the bank into a more aggressive, tech-driven lender, not just to SMEs, but also in a big way, car buyers and other upmarket customers. 2012 to 2018 was a golden run in the bank's history. A 30% CAGR in profits, increase in pan-India footprint, foreign institutional interest, and some assertive bets like a buyout of Deutsche Bank India's credit card business. In those 6 years, its share price surged from 8.50 rupees to 1,576 rupees apiece. One of its earliest strong decisions was a merger with Bharat Financial Inclusion. In fact, one of the earliest internal probes at IndusInd was on procedural lapses at BFIL. In 2020, Sobti retired and current CEO Sumant Katpalia took over. It is over the recent contentious tenure extension of Katpalia that the story we are talking about started coming to light. The bank's board had asked for a 3-year extension to Katpalia's tenure, which comes to an end on March 31st, 2025. The RBI gave him only 1 year. Here's my colleague and ET's banking ace, Saloni Shukla.
So yes, indeed, Mr. Katpalia's extension that the RBI shortened for the second time and that we got to know for the first time on March 7th. His tenure was getting over on March 24, 2025. And the bank board had already applied 6 months ago for his extension for a 3-year extension. There was a lot of buzz in the market as to, what the RBI would do. Nobody knew what the regulator would do. And then everything went downhill from there.
Why has the RBI been shortening the extension for Mr. Katpalia?
So, what has happened is that IndusInd has had a few regulatory run-ins since the time Mr. Katpalia took over, actually. And there have been a couple of penalties. One has been regarding not following KYC. Then the other has been how they are, managing their books. Then one more time, 2 years ago, they had informed that they had booked 84,000 accounts wrongly in their microfinance book. Anirban, very interestingly, I would like to point out that Mr. Katpalia has gone on record, and he's the first banking CEO to ever say that he feels that the RBI is not happy with his leadership skills. And, it's almost like, in an analyst call, he admitted that, he's committed to the bank for a year and the board of directors will look at external candidate. So, he was almost confirmed that he has got the boot.
That was March 8th, Friday. Just 3 days later, or rather the very next working day, Katpalia told the bank's investors about discrepancies in its derivatives portfolio.
So IndusInd Bank announced on March 10 that they had found discrepancies in their derivatives portfolio, which could lead to a loss of 2.35% of their net worth. And that would be a potential loss of 1600 crore in the March quarter.
So hold on here. Before understanding the problem, it's important to go back to how Sobati, the former CEO, used to run it, and a small but significant change that happened once Katpalia took over. Here's Krishna Appala, a fund manager at Capital Mind.
In those days, the focus used to be more on CV lending, commercial vehicle lending, and personal loans, etc. However, in 2020, Sumant Katpalia joined. He started focusing on NRI deposits particularly.
Right.
And why NRI deposits? Because they were relatively stable and they were long-term source of funding, and they directly caters to affluent and HNI clients. So if my memory serves me correct, the percentage of NRI deposits before Katpalia joined was below 5%, and now it is currently has moved to around 15% of the total liability book. So it's more of a strategic call saying that, okay, we have to focus on this particular NRI deposits, and that's where it happened.
The other significant occurrence, in fact, the most significant point of background here, is that in September 2023, the RBI issued a communique spelling out how banks should value derivatives. It said that all derivatives must be marked to market, or MTM, which requires valuing assets and liabilities according to prevailing market price. Now, let's understand what happened at IndusInd. Here's Krishna again.
So in a layman language, let's understand what happens with NRI deposits, and then we'll get back to what is the core of current issue. So let's say IndusInd Bank takes some deposit from a customer, from an NRI customer. For the time being, keep it as a simple, normal USD INR deposit. That's step one. But problem is that IndusInd is an Indian bank. Okay, if at all they want to lend in India, they have to transfer those dollars to India so that they can lend, they can expand their book here. Now, in this particular thing, step 2, which is ALM desk, which is nothing but asset liability management desk, comes into picture. So the job of this particular ALM desk is to manage overall asset and liabilities. Now, the $1 million which the depositor has deposited, the ALM desk has to convert into INR because they have to use them for their lending activities. And this is where something called internal derivative trade contract comes into picture with nothing but another department within the same bank, which is Treasury Department. Now, in the step 3, the trading desk, so please understand the difference here. ALM desk job is to manage risk, the currency fluctuation, and trading desk job is to generate PNL. Now, ALM desk gives this 1 million to trading desk and gets back, let's say, right now it is at USD INR is at 86 rupees. So it gets back 8.6 CR, 8.6 crores. Okay. And the contract between them, the ALM desk and the trading desk, is something like this. It says over the next 5 years, the two desks will periodically exchange interest payments. Okay. And at the maturity, which is 5 years from now, the trading desk will return 1 million to ALM, and ALM desk will further return 8.6 CR plus some agreed fee to the trading desk.
So usually when you get into any forex denominated forward contract, one leg is fixed while the other is floating. There will not be any change in the principal transfer, but there will be changes in interest payment transfers.
So right now what happened is, even though you did this internal hedge, the risk of currency fluctuation is still within the bank. Correct?
Right.
You just moved from one pocket to another pocket, one department to another department.
Correct.
Now this is where another leg, which is external hedge leg, comes into picture.
Mm-hmm.
Now what happens is that right now the buck is at Treasury Department, correct? Mm-hmm. Now this Treasury Department will enter a contract with an international bank or financial institution to hedge this current position. technically at this point, IndusInd Bank in theory should be perfectly hedged. Correct? You on one hand you are hedged on the internal leg, and on the other hand you are hedged on the external leg. Correct.
Right.
However, there is small problem here. The internal hedge which you mentioned happened at something called swap ratio, and that is a fixed cost. Okay. And the external hedge, because you are dealing with external bank, it has to be MTM, basically
Mark to market. Right.
Yes. Which this is MTM process is more reliable for risk management than any fixed cost.
So, for years, as IndusInd mobilized deposits in dollars and the yen, it also cut deals to hedge the risks arising out of exchange rate fluctuations. So, two departments of the bank followed different accounting rules. One showed upfront profits, while the other staggered the losses over a period. Once the RBI 2023 directive stopped this practice, the losses suddenly piled up. Now the question is, why? Why didn't the bank, a listed entity, report those losses for June, September, and December quarters of 2024? Why make that disclosure as late as March 2025? Here's Saloni.
So, in most likelihood, and this is what we have reported as well, that they were pushed by the RBI to make these disclosures, though they haven't gone on record to say any of this. They have said that, we are the ones making the disclosure, but we hear that it was the RBI that pushed them to make this disclosure, take the provisioning hit in one quarter, one-time impact, and just clean up the book. And, largely the shortening of Katpalia's tenure also comes from the fact that, somehow the RBI had lost faith because, you find out between April to September 2024 that you have such a big loss waiting to happen. And then, the market finds out in March of 2025 that something like, so it is really, lack of faith in the management, that the RBI has. So, yeah, it's a very pertinent question that you've asked, Anirban, that why such a delay, and even the market is sort of flummoxed that why the bank took such a long time to reveal this.
Understood. What was the impact of the revelation on the bank's customers? Did we see a bank run, etc.?
So we did saw some amount of deposits which flew out of the bank. We don't have the quantum. We will get to know the quantum when the bank declares the March quarter earnings. But it did sort of book about 20,000 crore of certificates of deposits, which it raised from other banks. So obviously, the buzz is that this 20,000 crore was sort of raised to, sort of fill the gap which, the other deposits would have made by customers who must have taken it out of the bank. So that is, the conclusion that the certificate of deposits basically were raised from other banks to fill that particular gap, which whatever would have made by the deposits going out.
And there was an obvious impact on the share price as well. But then, what happened is there was a twist with the RBI saying a few days later that all was actually well with IndusInd. Did that strike you by surprise as someone who's been covering it for so long? And what happened next?
No, it did not strike me by surprise, actually. Anirban, if you go back and you see a couple of similar episodes that have happened recently, be it Yes Bank or, with RBL Bank, where the RBI again removed the CEO and, instated a public sector banker. And now this particular, in all these cases, RBI had gone out and said that the health of the bank is fine, and whatever data it has regarding the capital strength of the bank, that is all fine. So it was basically trying to save the bank from a bank run, because Anirban, in banking, no bank can survive a bank run. It's next to impossible,
and nobody wants that. So the RBI has asked for Katpalia to resign. In fact, the bank's board and RBI are looking at an entire overhaul of the bank's top management.
Absolutely. So we have reported that the board of directors of the bank have taken this up really urgently. They have done two things. They are looking to appoint global executive firm Egon Zehnder to identify a new CEO and a new deputy CEO. The next thing that the board of directors are also doing, that they're looking to appoint a new COO, a new chief financial officer, new head of commercial banking, a new head of, retail banking. So you're going to see fresh blood. Okay. And this particular mandate could be given to another global executive firm, Korn Ferry. There are some people that are superannuating this year, and the bank feels that maybe the bench strength is not up to the mark, or they feel, that fresh talent from outside would be needed to sort of take the taint away, right? So at least for the part of the CEO and the deputy CEO, the bank is looking to fix this by June or July. They want this to do in the next 3-4 months. By June, July, they want it to send to the RBI. So the RBI has enough time to sort of approve the name of the new CEO. And then obviously the ball is in the RBI court, but that is the buzz that could happen.
And of course, all this has triggered 2 key investigations. PwC is trying to ascertain the bank's actual derivative losses, and Grant Thornton is doing a forensic audit, trying to actually investigate whether there was actual wrongdoing and who's responsible. Both have to submit their findings before the 31st of May deadline, by which the bank has to announce its 4th quarter results. With these reports pending and many key questions unanswered, the bank's statutory auditor will not sign its P&L account. Meanwhile, things have gotten murkier. The capital markets regulator has alleged insider trading at IndusInd, done by some of its key executives since January 2024 and worth several crores. Here's my colleague Reena Zachariah, who covers SEBI.
So what we understand is SEBI is looking at the trades that has been executed by the senior officials of IndusInd Bank, and they have also sought information from the bank based on the investigation that they have done on what they have to say about the trades that these executives have done on the stock exchange. So typically whenever a regulator looks into any kind of lapses in a company or an entity, like in this case it's a bank, and RBI is already investigating or examining their books of accounts. Now in this case, what would have happened is also that SEBI has kind of examined all the trades that have been done by the key management personnel of IndusInd Bank, and what they have observed is that some of them have actually executed trades of buying and selling in the last few quarters, and that has kind of caught their attention, and they have written to the bank seeking their response from these executives on whether they were in possession of price sensitive information when they executed these trades, also whether they had disclosed this information to the stock exchanges, if they had come out with a trading plan which they had taken the proper approval from the compliance officer. So these are some of the things typically SEBI looks into when these kind of situations come to their attention.
The SEBI has also alleged a violation of disclosure norms.
And that is because if any information which the board thinks is material and it has to be disclosed, now they can always, say that probably we thought that, this is what in the analyst call the management has, this is the position the management has taken. They said that we could not understand the estimation of this loss, and hence we thought that, it's not appropriate to make this disclosure at this point in time, and probably later on at a later point, probably we could disclose these information to the public. But even when they made the decision on March 10th to make the disclosure, even then they were not able to really estimate the losses. So if they were not able to estimate the losses on March 10th, what would have probably stopped them from making the disclosure earlier? Because anyway, they have not been able to estimate the losses. So in that case, they could have, disclosed it upfront to the stock exchanges, saying that, these are some of the findings that we have internally come across, and probably, put it out in the public domain. So these are very important things when it comes to material disclosures actually to be made by companies. So these are some of the things probably which SEBI is looking into.
Now, There are many questions that need answering. Here's Saloni.
No one knows, the deeper questions that, no other bank faced this issue. It could only not would have been because of the RBI circular, because, I have spoken to other banks who have said that only this particular circular doesn't explain this issue. So if hedging was not done, why it was not done? Who was aware of this particular issue, who was booking such trades and, not taking hedging against such trades, not booking losses. And, the biggest question is, was the top management aware of this? That is the biggest issue, and that is what the RBI is trying to find out, from the forensic audit. So these are some of the questions which will only get answered, Anirban, in the days to come.
Also, the RBI. Did its inspectors know about this issue? What about IndusInd's auditors? Were they aware? Everyone is waiting for these answers. As my colleague Shukla Ghosh wrote in a piece on Thursday, the bank's founders, the Hindujas, who have actually pledged half their holdings in the bank and have also separately gone in for another big acquisition, Reliance Capital of course, certainly wouldn't want this to balloon to a scam. Most importantly, the government cannot afford another private banking debacle just 5 years after what happened at Yes Bank. Many of these questions are likely to get answered in the coming weeks, and we at the Morning Brief will keep breaking it down for you in subsequent episodes. That's it for today. You were listening to this episode in the Morning Brief. It was produced by me and Vinay Joshi, sound design by Indranil Bhattacharjee. A new episode of the Morning Brief drops every Tuesday, Thursday and Friday, wherever you get your podcasts. Have a good weekend.